Okay, so good evening, everyone. This is module 5 of the Personal Financial Makeover Program. And in this module, we're going to be covering asset classes. So for this module, what I want to do is to introduce you to the different types of assets, and then to kind of give you like a practical expectation. A bit of practical information about the different types of assets, as well as to give you an indication as to what the realistic return from each of these asset classes would be. So, all right, getting into it. So first of all, what's an asset? So an asset is basically anything of value that you either own or control and is able to produce some economic benefit or some economic value. You want to you can basically think about assets as just things that you can put your money into to have your money work for you instead of you just working for money. So you can look at assets are typically things that persons can invest into. So typically anything you can invest in, you can consider that an asset. And there are, of course, many benefits to owning assets. A lot of us here would have understood from the savings presentation last week that it's near impossible to save your way to building a significant amount of wealth. And so what assets do is they are able to provide additional sources of income as well as serve as mediums for within which you can grow the money that you would have saved. So one of the major purposes of assets is for you to actually invest in them such that you can generate higher returns than just keeping your savings and getting the interest associated with that. So you have assets that will give you returns in the form of interest and dividends, but also we have assets that will simply serve as a means of protecting you against inflation. And of course, you have the most assets will appreciate over time, allowing you to build a significant amount of wealth. And of course, with all assets, they're going to come risk. And the risk with a lot of assets is that they have different cycles and different performances across economic cycles. And so you may see the value of your asset depreciate under certain economic conditions. And you may even end up losing your investment in those assets. Assets can also be very illiquid in the sense that not all assets can be easily tradable. And we're going to talk about a few of the different assets, but some assets, it's very hard to convert them into money or to convert them into cash. And then, of course, all assets are going to be subject to different types of risk, whether they be market risk, inflation risk, liquidity risk, counterparty risk, etc. Assets are so assets can be classified into three broad categories, and there is some amount of overlap between those categories. So you have, broadly speaking, there are physical assets. Examples would, and we're going to go through them, but examples would include real estate, which is raw land, commercial buildings, residential buildings, etc. Um, Gold, silver, wheat, oil, stuff like that, equipment as well. And then typically these will either have an intrinsic value or their values are tied to the economic production that you can get out of them. Then you also have physical assets. And typically, these physical assets are going to be like your bonds, your stocks, um, deposits, CDs, unit trusts, etc. And most of them are really tied into future cash flows, whether that is in the form of dividends or interest. And of course, you do have some physical assets that will have a financial asset associated with them. So if, for example, one is supposed to convert a piece of real estate into a mortgage-backed security, then the real estate, which is a physical asset, is going to produce income of its own or produce cash flow off of its own, but also the contract, which is a mortgage-backed security, can also have cash flows that produces. And lastly, you have intangible assets. So intangible assets are going to be anything like intellectual property, digital assets, NFTs, goodwill, as well as the rights that will be associated with the future benefits. So, for example, a contract can be considered an intangible asset. Having a very large user base or a very large email list is also an intangible asset. And I'm moving forward. All right, so I'm going to quickly run over the basic assets. And most of these are going to be the financial assets. They're the ones that most people are very familiar with. So I know I can go quickly through them. And then we'll get down to the ones that I really want to focus on, which are more the alternative assets. So your intellectual property, your cryptocurrency, real estate, although a traditional asset is actually considered an alternative asset. So we'll be focusing on those three, and then I'll also talk a little bit about business. And there are a lot of things that will be wrapped up into business, which is why I want to talk about real estate and intellectual property first. So in terms of stocks, most of us will already know that stocks represent a share of ownership in a company. And basically, it gives you an entitlement over the profits of those companies as well as the assets of the company. So once you buy a stock, you are a part owner of the business. The advantages of stocks is that there is a potential for high return or higher returns compared to other traditional assets. They're very easily bought and sold because they are traded on recognized exchanges, so they have very high liquidity. And of course, those ownership rights um, tend to give you either voting privileges or dividends. And I should mention here that there are, in fact, two different types of stocks. There are ordinary stocks or ordinary shares and preference stock or preference shares. With preference shares, you don't get voting rights, but you do get first claim or first charge over the assets of the company should the company be liquidated. And then some of the challenges that are associated with owning stocks is that for the most part, stocks are extremely volatile and are subject to significant price fluctuations. There is no guarantee on the returns when you invest in stocks. And the reason for that is because when you purchase a stock, you are undertaking the same level of risk as the persons who would have started the company. So the initial shareholders. Another thing about managing stocks as a part of your asset portfolio is that it does require for you to keep abreast of what's going on in the economy, in the news, in the industry that company is domiciled in, and it does require significant amounts of research. There are ways for you to get professional people to do this research for you, and we'll talk about that on the unit trust, mutual funds, ETFs, etc. Um, the typical return on stocks is between 7 and 10% annually, and this is taken over a long term. So if you look at the last 25 years, the last 50 years, you'll find that the average return on stocks is between 7 and 10%. And so it tends to keep pace with inflation or slightly outperforms inflation. There are unique instances where stocks can see abnormal returns, especially when the company is one that is involved in a very high growth field or is disrupting a traditional industry. So examples would be Apple, Microsoft, NCB Financial Group. It's also a stock. Toyota is a stock that's listed on the Nikkei exchange in Japan. And then, well, I'm going to share something as it relates to stocks for everybody that is here. If you don't already have it, I'm going to give you my entire stock market masterclass, which is about five five or so hours of video. So I'll be collating that and then putting that together in a playlist, and then I'll share the playlist with you. So if you're new to stock market investing, that is going to help you. But also, if you want to just take your first step into stocks, you have less risky alternatives through which to do that, and one of them could be through either an index fund or a unit trust. Another form of a financial asset is bonds, and bonds are basically debt securities that are either issued by companies or corporations. And what a bond is, it's basically a glorified loan. So when you purchase a bond, you purchase what is known as a face value. So it's an amount of the bond. And the bond is going to have what is known as a coupon or an interest rate associated with it. So if the interest rate is stated as, say, 5.25%, then you can expect that if you invest $100,000 into the stock, you will be getting $5,250 every year. And the coupon is either paid um, quarterly, semi-annually, or annually. The average return for bonds is between 3 to 5%, so somewhat lower than stocks. But the reason for that is because bonds are seen as being traditionally safer than stocks, so they're subject to less volatility. The global bond market is actually the second biggest market in the world after the foreign current after the FX market or the foreign exchange market. And as at today, it's valued at approximately $128 trillion. So on a whole, in terms of assets that are traded, the bond market is actually the largest one by size. And of course, you have different types of bonds. So you can have corporate bonds, which are issued by companies. These tend to have a higher yield because the companies are seen to be more risky than, say, government bonds. So like government of Jamaica bonds, US Treasury bonds, UK bonds, or Canadian bonds. You also have municipal bonds, and these are typically issued by local governments, and they're typically used to fund things like infrastructure development, typically within a particular city or municipality. In terms of bonds, if you're going to get started in bonds, I should mention that bonds are typically have a higher minimum requirement in terms of the amount that you have to pay to get into a bond. So traditionally, before you could open a bond account, you would need, say, between 50,000 and 100,000 Jamaican dollars. More recently, companies have been doing something called a bond IPO, basically where they issue bonds as opposed to issuing shares, but the return on those is higher than your government bonds, and the amount that you need to invest to get started in those bonds is also lower. So if you look at, for example, a Mayberry bond, a Barita bond, or I'm trying to remember if there was a third company that might have put out a bond, but let's use Mayberry and Barita. Those two would have come out and you could have gotten into them between like $10,000 and $25,000. Unit trust, I spoke to this as being one of the more conservative ways for you to get into investing in stocks, but there are also unit trusts that are focused on bonds. So that's why I put it after those two, because unit trust, being a pooled investment scheme, allows you to basically get into other investments that you would normally be able to get into. And one example of that is a real estate unit trust. So typically, if you were supposed to get into real estate, you would need millions of dollars if you're going to buy the properties yourself, or develop them. In with a real estate unit trust, you can buy a unit of that unit trust. And it could cost you, I think the lowest one I remember seeing is around $500. Barita's own is, I think, over $1,000 now. But you can get into those with a reduced amount of investment compared to actually getting into actual physical real estate. And some of the benefits of the unit trust is that one, they're typically managed by professionals. So a lot of people with expertise in money management or asset management, they have what is known as an open-ended structure, which means that they can issue an unlimited amount of units. What that means is that once you have money or once there is money to put into the fund can continue to grow. So it's not capped unlike, for example, a private equity fund, where once they raise a set amount of money, that is it. You can no longer get into that fund and you have to get into a separate fund. They are priced once daily. Um, so, and it's priced on something called a net asset value. So I actually worked at a financial institution where I was responsible for their equity fund. And I was also responsible for calculating the net asset value. So how you calculate the net asset value is basically you look at the price of all of the assets that are within the fund. You subtract out the fees and expenses associated with the fund, and then you divide that by the total number of units that are within the fund. And that will give you what is known as net asset value per unit of the fund. Historically, unit trusts will also return. They tend to have a similar profile to the stock market. Other unit trusts, I don't think have really been around locally for long enough for us to see like what is their 25-year, 30-year track record. But for the stock and bond unit funds, those unit trust funds, those tend to average between 6 and 8% per year. And here are some examples of some of the funds that exist out there. So locally, you have the JMMB funds, you have the Sagicor Sigma funds, you have NCB Capital Markets unit trust, which is they have a equity fund, a bond fund, and a money market fund. I don't know that they have launched a real estate one, but there are companies out here that have a real estate fund. JMB has one, Sagicor has one, Proven has one, and Barita has one. And then overseas, you have the Fidelity Growth Fund. The advantages of the unit trust, I would have explained this, is that you are able to get into different asset classes at a lower cost. You are also able to invest across multiple different asset classes. And of course, they are professionally managed. The disadvantage is that for most of them, they're going to have fees associated with them, but these fees are typically minimal. You do not have control over what is in the fund. So you will not be able to, for example, say, sell if you wanted to construct your portfolio and you have a fund in there, then you're not able to say, okay, get out this particular stock. You also will have exposure to different market risk once you are invested in the fund. Mutual funds are sort of similar. They are also places where people will pool their money to buy a diversified portfolio, and that could include stocks, bonds, as well as other securities. And they are also professionally managed. You have different people will contribute to that fund. So in a mutual fund, you can have individuals in the fund. You can also have companies invested in the fund, and you can also have pension funds that are invested in the fund. They have similar advantages to unit trusts in that they are professionally managed, they're typically diversified, and they are also priced once daily. The disadvantages with them are also going to be similar in that you do not have control over what is in the fund, but you are able to come out of the mutual fund at any point that you want. So you do have some level of liquidity as it relates to the mutual funds. And different examples are Fidelity's Contra Fund, the JMMB Balance Fund, BlackRock's Global Allocation Fund, and the Vanguard 500 Index Fund. Speaking of index funds, let's talk a little bit about that because those are slightly different than your mutual funds or your unit trusts. The primary difference between an index fund and a unit trust, for example, is that the index fund is based on an already existing index, and persons can create the index. But for example, in Jamaica, we have the main market index. We also have the manufacturing and distribution index, and we have the financial index. Now, Sagicor has created a fund that is called the Manufacturing and Sagicor Select Fund, and it's called Sagicor Select Fund Manufacturing and Distribution. That is an index fund that actually tracks the Jamaica Stock Exchange's manufacturing and distribution index. Overseas, you have the S&P 500 index, which is created by Standard & Poor's, and it comprises 500 largest companies in the United States. The average return for your index fund is going to be 7 to 10%, which is effectively the return of the market. And the expense ratio is extremely small. It's about 0.1%. And one of the reasons why it is so small is because the fund is not really actively managed. It's more passive in the sense that the index doesn't change as often as somebody that might be managing a fund. And so there isn't a lot of expense associated. Basically, you can consider an index fund as something that you just set and forget. Um, Something I should mention about index funds is that the the index um, fund is going to be comprised of all of the companies that are within the index. And so there is some form of limitation there because if, for example, you are invested in the financial index, then you will only have financial companies within that. And so there is something called a concentration risk when you decide on different index funds. Um, Examples of them would be the Vanguard S&P 500. A lot of people see that known as VOO. You have QQQ, which is the NASDAQ index, and you also have Emerging Market Index and Schwab's Total Stock Market Index. Exchange traded funds are sort of a mix between mutual funds and index funds. And the difference between the exchange traded funds is that they basically trade like stocks. So you can go to a company and buy an exchange traded fund. And then you can sell it back the same day if it goes up, if you want to do that. So that is somewhat different to a mutual fund where the mutual fund is only priced once per day. So if you buy today at say $500 and you wanted to get out of it, that's the same price that you would get. But with an ETF, if for example you buy QQQ and the index go and then one of the companies reports earnings and the price of the ETF goes up, you can sell the ETF at the end of the day because the price is given in real time. You can sell it at the end of the day at a higher price. So the major difference is that with the unit trust or mutual funds, it's priced once for the day, but with the exchange traded fund, it has a stock-like characteristic in that the price of it changes multiple times throughout the day. What else should I make? Oh, so ETFs also will give you similar returns to a unit trust. But again, it can exhibit stock-like qualities. So you could see the return on an ETF going beyond that of a unit trust or a mutual fund. And so the average return is going to be between 6 and 10%. And of course, it's going to depend on what the underlying asset is and the market conditions. So that covers most of the financial assets. So now let's talk about the more nascent assets. So I'm going to start off looking at gold bullion, then I'm going to talk silver bullion and real estate and NFTs. So for gold, gold is a physical asset and it's traditionally seen as a hedge against inflation. Um, Gold gets its value from one, its rarity, and two, it has historically been seen as a store of value. So gold typically has a much lower return than your traditional financial assets. So the here you can see that the return above inflation has typically been above about 1 to 3%. And the reason for that is because gold aims to maintain one's purchasing power. Um, if you are going to store physical gold, then there are different companies out there that will store your gold for you. One of them is called Citadel, and the cost to store the gold is typically going to be between 0 and 5%. Of course, you can store your gold yourself, um, but that's not necessarily advised. Um, and then in terms of gold, what you want to do is you want to look at the purity. And so for pure gold, it's going to be about 99.99%. And that is really just the purity standard. It's known as the 4 nines purity. So popular forms of gold would be like your American gold eagle, your American gold wolf, Canadian gold maple leaf, the gold bars, and the South African Krugard. That is also a different form. That's a gold coin. So all the ones that you heard me mention just now are gold coins. And then after I'm done here, I'm going to basically show you an example of the different gold coins. If you want to buy physical gold, there are two places I know you can do it. One is APMEX, which is American Precious Metals Exchange, and the second one is jmbullion.com. Silver, pretty similar to gold, so it exhibits similar qualities, except that silver is orders about typically silver is about 50 times cheaper than gold. And that ratio has historically been maintained. So if gold is say selling for let's say gold is selling for $1,000, silver is going to be selling for about $50 thereabout. Um, in fact, no, I think gold price is about $3,000 and silver price is about $30. So in this case, the disparity is now what, 100 times. So based on that, it is generally conceived that silver is undervalued. And you can get silver in the same places. So you can get silver on jmbullion.com and on appmix.com. So I buy silver, um, typically try to buy 1 or 2 coins a year. And I buy them from appmix.com. So the characteristics of silver is that it also has what is known as dual demand. So silver has a lot of industrial uses. Silver is actually a much better conductor than copper. So is gold, but I mean nobody is going to use gold as electric distribution mechanisms. So nobody's going to do that. but silver has a lot more industrial applications. And so it has that dual demand. The other thing is that it's actually more volatile than gold. So when I first bought silver, I bought it at $15 as a spot price. The spot price is basically the the price before, you can call it the wholesale price. That's effectively what it is. So I would have started in 2015 buying silver, and I bought them between 15 and $20 per ounce. Now silver is between 30, I think it's 30 and $33 per ounce. Um, so to that end, it's naturally more affordable. And the historical return also it mimics that of gold in that it tends to keep pace with inflation. So it will give you a return that is slightly above inflation. Popular examples of the silver bullion are going to be your American silver eagle, the Canadian um, silver maple leaf, the howling wolves, which is I'll show you an example. And then you also have the silver bars. So more non-traditional assets, art and collectibles. So these typically are going to be tangible, but now with NFTs, you have intangible forms of collectibles and intangible forms of art. I'm going to log into one of my um, wallets and show you two examples of intangible NFT collectibles. Um, I should also mention here that you also have music as a form of art that is collected. So like people will collect vinyls and so on. So the significance, the value of these types of assets are typically based on either desirability, cultural significance, or rarity. So the harder it is to come by any type of art or collectible, typically the more valuable it's going to be. It also helps if there is a community around the specific type of collectible. So baseball cards, for example, that is a very big community. And so there are rare baseball cards are seen as extremely valuable. Persons have also started to do this with sneakers and t-shirts and all sorts of different apparel. But the basis of it is one, either there is a pop culture significance that's associated with it. It's very rare or it's highly desirable, either because of the design or the designer. So, um, other examples of art and collectible would be sculptures, and then you have print. So sculptures can either be marble, stone, or wood. You will have wines and spirits, so rare vintage wines and limited edition spirits from well-known houses. That's what the producers are called. So you have like the house of let me try and remember. Uh, Sorry, my rare wines are missing me now. But yeah, just like how you have like Chardonnay or you'll have Yellowtail, there are more expensive houses of what's the word? Wineries. Mm, Vineyards is the word I'm looking for. So they are more expensive vineyards. Classic cars are going to be another area where you have collectors, and so um, your Mercedes-Benz Gullwing is going to be very valuable. Your old Bugattis, this would be from the 80s and the 90s. Those Bugattis, very expensive. Your Ferraris from your 40s and 50s, also very expensive. Um, Other vehicle, I think one of the also one of the more expensive vehicles is going to be the McLaren F1. I think that's now like $2 million. No, but it's extremely rare, very, very hard to find. Rare Porsches exam are also other examples. And then I mentioned the collectibles. So you can these are going to be your watches, books, um, sports memorabilia, whether it's a helmet, a baseball that was used in a finals game, football, or you can have like rare coins, rare stamps, etc. The annual historical returns on these are going to be between 5 and 7%. And of course, the individual item can vary significantly based on whether or not it's been known to outperform or underperform. And also, there are going to be considerations for the category of the art or collectible, as well as the the creator or the circumstances around it. Typically, with these things, the story around them also matters, and so the better the story, the more valuable that item is going to be. If I were to give you a tip on this, it would be to invest in areas that you, one, have a genuine interest in, and would have devoted significant time to kind of expand your knowledge about the area. Um, yeah, and you can also start off by fractional ownership. So I would have done this, for example, with some of the NFTs. I just bought one or two issues, and then I'm just waiting to see how it goes before I decide to go into other things. Pokemon cards is another example of this, as well as I mentioned baseball cards. Speaking of NFTs, let's also look at cryptocurrencies. So cryptocurrencies are basically code. So they are code that is used to represent money. And the most popular one, of course, most of you would know, is Bitcoin. So Bitcoin is now seen as digital gold and is considered both from a regulatory and a financial perspective as a recognized store of value. Um, Bitcoin would have been the first cryptocurrency that was created, and it is the token associated with the Bitcoin blockchain that was created in 2009. There are a maximum of 21 million Bitcoins, and nearly all of them are now mined. So Bitcoin will get its value from one, it is now seen as a store of value, but more importantly, it is very limited. So the overarching supply of it is extremely constrained, and the demand for it is extremely high. And so its value has continued to creep up. Now, Bitcoin is worth well over $100,000. When I first heard about Bitcoin, it was trading for around 5,000 US dollars. The current market cap for Bitcoin is about $2 trillion. That is still nowhere near the size of the stock market or the bond market. And for that reason, Bitcoin, even at today's price of 100 and something thousand dollars per coin, is seen as undervalued in comparison to the other asset classes. Another thing I should mention about Bitcoin is that whilst Bitcoin is 100,000 odd, there are other forms of cryptocurrencies now that are cheaper and are gaining just as much relevance. So Ethereum would have just crossed, I think, 4,000. So either 3,000 or 4,000 as of yesterday, it would have crossed. Um, Cardano, Cardano is another one that is really based on what is known as proof of stake, as opposed to Bitcoin, which is based on proof of work. And then you have Solana, which is another one that's really gaining prominence now. And that is really for high performance and is really focused on low speed. There's also Dogecoin, XRP, there is Polygon. Um, there are hundreds of thousands of cryptocurrencies. The tip with this is that because cryptocurrencies are extremely volatile, it is possible to lose all of your money. And I have lost significant amount of money in different cryptocurrencies. So the idea here is that you don't want to invest more than what you are willing to lose. And personally, I would not invest more than 5% of my investable assets into cryptocurrencies. So there is a potential for very high returns, but there is also the potential of being completely wiped out because there is this practice in the cryptocurrency space now, despite regulations that are coming, of people doing something called a rug pull, basically where they launch a project, they over promote it, so they will get like celebrities and all persons of credibility within the social media space to promote the coin, get it out to a whole bunch of people, and they will have their insiders once the coin goes public, in what is known as an ICO, initial coin offering. What they will do is basically just sell all of their coins into that hype, into the market that would have been built up, and you are basically left holding those coins. The team and all the people who would have developed the coin would have basically used you as what we call exit liquidity. So they sell you, they get the money, you are now holding the coin that they no longer support. So you're effectively left holding a useless asset. Non-fungible tokens is another technology that would have been developed on the backs of cryptography, or is the same blockchain technology, really. And then these non-fungible tokens, the idea, and I say the idea because this is not always true, is that they are supposed to be unique and indivisible, but oftentimes they are not unique. And especially in the case where somebody wants to do a rug pull, NFT is a good way to do it because they are presenting you with something that seemingly has value based on the fact that it is completely unique. The only thing that is typically unique about a lot of these NFTs is the unique identifier. So the actual code underneath um each of the individual NFTs. But on top of it, there is typically nothing else that differentiates the NFT. Where NFTs tend to be getting value now is with the benefits that are associated with the NFT. So whether it's royalties, whether it is exclusivity, or it could be benefits that are associated with persons who hold that NFT. So some form of community identification. So again, prestige and exclusivity. For the most part, the NFTs are verified by the blockchain. And you, as the owner of the NFT, you're basically able to prove that you are the owner. So whilst, say, for example, there is an art piece that is then tokenized. And by tokenized, I mean that they create a code that is going to basically be directly tied to the, one second. Sorry about that. So let's say they tokenize a piece of rare art. So they tokenize the Mona Lisa. What it basically means is that that code represents now ownership interest in the Mona Lisa. And so if you have a part of that, one of that NFT, then um you will have provable claim that your asset is tied to the actual original. So that would be one of the benefits. And so based on that, the value of your NFT might go up. You have other forms of non-fungible tokens that persons have created. So for example, people have tied NFTs to their to the tickets to their concerts. People have tied NFTs to entire albums. So for example, Tory Lanez had launched an album that was tied to an NFT. So only people with the NFT are able to listen to that album. And I'll show you an example of that. However, as I mentioned, it's not sometimes the NFTs are not as unique as they claim to be because for that album, there were a million copies of it. And so you have a million instances of this very said album. Now, it is unique in the sense that only those million exist, but also your NFT that I would have for the Tory Lanez album is no different than what another person would have. And so that kind of constrains the price on that asset. So some popular NFT collections, you might have heard about them. The Board Ape Yacht Club is one that all of the celebrities were buying. So Justin Bieber had one. Um, who else? You name the celebrity, basically. They had one. Paris Hilton had one. A whole bunch of persons would have bought Board Ape Yacht Club. And there were these monkeys. Again, I'll show an example. Um, and they were sold for hundreds of thousands of US dollars. Some of them were even sold for $1 million. You also have CryptoPunks, which is the first NFT that collection that was created, and so it gets its value from its novelty. You have NBA Top Shot, which again is tied to baseball card, well, NBA cards in this case, but it's cards for NBA players. You have art blocks, and of course you have the sort of more they're not more popular now, but they're more how do I want to say it? Um, Pop culture centric. So for example, Gary V's V Friends is one example of that. And then you have the rare NFTs such as Beeple's Everyday, which is one of the most expensive, I think it's the most expensive NFT art piece that has been sold. Um, there are risks, and I've mentioned some of these. So you have very high volatility. Some of them are based on hype. The liquidity is often an issue. There are sometimes technical risk because you can have bugs in either the blockchain that the NFT is created on, the smart contract that is tied to the NFT, or you can have breaches in your cryptocurrency wallet, whether it's a hot wallet or a cold wallet. Um, right. And of course, there is currently no regulatory framework really for NFTs. Whilst there is one for cryptocurrencies, there isn't really one for NFTs. If you want to buy NFTs, there are different places that you can buy them. OpenSea and Rarible are the two biggest NFT platforms. I'll show you both of them, but there are also smaller NFT platforms like ENFT, and there's another one that I have some with that I can't remember. It will come back to me. It's the one that Gary V's NFTs are sold on. Once it comes back to me, I'll share that. Now, um, one of my favorite asset classes is intellectual property, IP. And this basically is an intangible form of asset, and it's based on things that you create out of your mind. So I like to say that intellectual property is the best asset class because you can develop it using $0. So you can basically create value out of thin air. Now, there are different forms of intellectual property. So copyrights, patents, trademarks, trade secrets, as well as processes. Um, in terms of monetizing intellectual property, the way that they generate ongoing revenue is typically through licensings, royalties, or commercialization. So if we were to look at each of them individually, the patent is typically an exclusive right that you get as the creator of something. So if you invent something, you can patent. You can also patent things such as formulation. So if you create a new drug, software processes, as well as mechanical devices. Copyrights are just legal protection over things that you create. So songs, books, films, software, artistic works. Copyright protection lasts for, I think it's 70 years in the US. In Jamaica, I think you kind of have to renew it every 10 years. And then you also have trademarks. So these are just words. They can be symbols, they can be sounds, they can be designs. Um, and the difference between a trademark and a patent is that the trademark can be renewed indefinitely as long as it remains in use. So, for example, with my company, I have the trademark for the word and the symbol Caribbean Value Investor. I also have the trademark for the Harbor Street Review, both the words and the um, the mark. So I have the copyright for the words and I have the trademark for the word and the mark. And then you also have trade secrets. So if you, for example, develop a, a brand new way to, well, let me not go so far out with the example. You can simply think of trade secret as the Coca-Cola formulation or the 11 spices that make up KFC's formula, KFC's secret recipe. The return that you get on trademark is going to vary widely, and it depends, of course, on like the usage of the trademark, who has it, um, where it is used, as well as which jurisdiction it applies in. So typically for trademarks and licensing, you have to get them registered in each geographical area that you want them used. And of course, the value of them can range from $0, so you can have a trademark that's worth nothing, to hundreds of millions of dollars, if not billions of dollars. Real estate, this one I can go easy with. Most people understand real estate as an asset. So you can either have raw land or you can have commercial or residential real estate. And of course, most of us know that the way that real estate pays you is either in you leasing it, you subdivide it, you develop it, whether you're going to develop it as agricultural land or for commercial or residential purposes. So if you decide to go residential real estate, then of course this has different forms that it can take. So you can either create a single family home, you can create an apartment complex or condos, or you can create a multi-family property. So that's basically a house, but you can divide it up into three or four, where you rent it out to different families. This is actually the way that most real estate exists in Jamaica. So you, for example, would have built a house and then you attach another, you build on another part of it and you rent out the house to different families. The investment returns that come from residential real estate are going to be in two forms primarily. One is going to be the rental income. So that's the cash flow that comes back from it, as well as the property appreciation. You can take advantage of real estate in two other ways, but this is under very unique circumstances. So you have the tax benefit, but this is only going to apply if real estate is your primary business. And then you can also have equity that you can build up in the real estate, and you can leverage that equity to access capital to do other things that you might want to do. Real estate is going to typically return between 8 and 12%. And that is when you consider both the income side of it, so the cash flow from the rent, as well as the capital appreciation. Commercial real estate, this is where most of the big boys play. And the return is going to be between 6 to 10% annually, looking at both the combined cash flow and the appreciation. Typically with commercial real estate, they generate cash flow through lease agreements. And the leases are typically between 3 and 10 years because they're rented to commercial enterprises. You can do a lot better with commercial real estate, especially if you get in something known as an anchor tenant. And an anchor tenant is typically a large corporation, a big business that decides to take up residents in your piece of real estate. So if you have, for example, a PricewaterhouseCoopers that rents an entire floor, if you have a bank that is one of your tenants, if you have who is another big anchor tenant that is known, KFC, for example, so fast food chains. Typically, those will stay between 5 and 10 years, and those will also attract other tenants to your property, hence why they're called anchor tenants. Commercial real estate types are going to be office buildings, retail spaces, industrial properties, and then you also have your special purpose facilities. So like data centers, for example, which is a big one now in the US with the advent and the growth that we're seeing in artificial intelligence. And then the last one I want to go over is business. So business ownership is traditionally seen as one of the highest potential returning assets that you can own. And there are different forms of businesses. There are franchises, small business or SMSEs, online businesses, and then startups. Naturally, the startup, if successful, will probably have the highest return, especially if you take it public after a while. The online business is going to give you a lot of freedom, good returns as well, but typically not as much as your startups. Franchises will typically give you the lowest return, but they have the lowest risk because typically you're franchising from an established company. So either you're opening a Burger King franchise, McDonald's, KFC franchise, etc. And then with a small business, typically these will provide steady cash flow, and a lot of them include professional practices. So your small accounting firm, your mechanics, for example, bakeries, etc. So historical returns is between 10 and 10%, 10 and 30%. And that's really the potential is higher than that, but they do come with significantly higher risk because they have higher failure rates than the other traditional investments. And of course, if you're going to start a business, the advice here is that you want to start one in an area where you have some level of expertise, but not only that, where you also have the network, because especially in business, your network will determine your net worth. An alternative, though, is for you to buy an existing business, and there are now a lot of creators that are coming up talking about this as the route to take, where you buy an existing business, improve it somehow, and try to get a higher rate of return from the business, or even sell it to either a bigger company or to a private equity firm that will eventually take the company public. So that this is actually the last one. The last one, and I don't really well, it is an asset, but I don't, it's one of the lowest, it is the lowest returning form of asset, and that is cash. And that is going to be either cash that you have in a savings account, a money market account, or a CD. And here I've organized them in terms of the return profile of each of them. So your savings or checkings account is going to give you 0.01 to 0.1%. High yield savings account will give you between 0.5 and 2.5%. So I know I have up to 1% here, but some of them actually give you up to 2.5%. Where the high yield savings account is invested in a money market account, you can see up to 5% locally. Internationally, it will be between zero, I want to say 1% and 2.5%. And then you also have like certificates of deposits, which are issued by the Bank of Jamaica or the central bank. And those will have a typically higher rate of return. They'll have a fixed term between 3 months or up to 5 years for some of them. And the returns on them in Jamaica is between 6%, 4% and 6%. It's important to have some cash in your portfolio. We talked in previous sessions about having your emergency fund, but you also want to have cash to take advantage of investment opportunities, as well as cash is a good stabilizer in the event where you have high market volatility. So you can use your cash to do such things as averaging down on your investments, or you can use it as a means to avoid getting your debts called, or to supplement the interest income that you will be generating from your other forms of investment. So the tip here, of course, is to keep enough cash on hand, but just about as much as you would need. So enough to cover your emergency and your short-term needs. Typically, again, from last week, we talked about the 3 to 6 months, and I did share some strategies as to how you can start building up that cash reserves. The caution about cash is that cash loses value to inflation, and so, or depreciation, devaluation, sorry. And so you want to have excess cash invested in the market or in different asset classes as a way to preserve your purchasing power or generate additional income. So that basically concludes the presentation on assets. And as promised, so I'm going to stop the recording here, but as promised, I'm going to share with you some of the platforms where you can see NFTs, for example, as well as your gold and silver bullion, if that's something that you're interested in. Oh, and also I'll share platforms where you can actually buy cryptocurrencies if you're interested in that.